If you only have $100 in your trading account, this is exactly what I would do. Trade a simple supply and demand trading strategy. After testing over 10,000 levels, I found the one that will work even if you have a small account. So after watching this video, you will become a pro at finding the levels that actually reverse the price. But before you do, let's debunk the first misbelief that you have about day trading. Let's kill the most expensive lie in trading right now. Because if you believe it, you will either never start or you will blow up the account you do have. That lie is, I just need a bigger account. And I get it. You look at the 100 and think, what's the point? I'll make $3? So one of two things happen. Either you never actually start, you just keep watching videos waiting until you've saved enough. Or you do start and because $100 feels too small to matter, you over leverage it, trying to turn it into $1,000 in a week, and it is gone in 3 days. Both of those kill you before you ever learn anything. Here's the truth. The gap between you and profitable isn't capital. It's that you can't tell which price levels on your chart actually matter. Think about it. A $100 account trading genuinely good levels compounds. A $10,000 account trading random lines just evaporates slower. The account size only multiplies whatever process you already have. If the process is guessing, a bigger account just means you lose money faster. So what does $100 actually do? Realistically, you're trading microloads, or you're gonna use it to fund your first prop firm account. And here's the mindset shift that matters most. At this stage, your job is not to make money. Your job is to prove you can execute the same process 100 times without deviating. That's it. If you can do that with 100, scaling is just a math problem later. If you can't, no account size will save you. So it is not the account. What is it? It's a lines on your charts, and I bet 90% of them shouldn't be there. I can look at someone's chart for 2 seconds and tell whether they're profitable or not. Here's what I'm looking for. Lines. Dozens of them. Levels drawn everywhere from every time frame going back weeks. And here's what all that clutter actually does to you. It removes clarity. You've got 15 levels on the screen and you have no idea which one is going to hold and which one is going to break. So every single trade becomes a coin flip dressed up as an analysis. Those levels don't protect you. They only lead to unnecessary losses. And it comes down to 4 specific mistakes. Almost everyone makes them with supply and demand. 1. Doing multi-timeframe analysis. 2. Choosing random highs and lows. 3. Using levels that are old. And 4. Having no time reference at all. Every messy chart I've ever seen is some kind of combination of those 4. And the fix is not what you'd expect. You don't fix a messy chart by adding a better indicator or a smarter rule. You fix it by subtraction. Fewer levels, better levels. By the end of this video, your chart is going to have maybe 2 or 4 levels on it. And every single one of them will have a reason you can explain out loud. But before I show you which levels to keep, you need to understand why levels exist in the first place. Because once you get this, you will never draw a random line again. Almost nobody explains why price reacts to these levels. They say it's a level, price bounces. And that's exactly why people can't tell a real level from a fake one. Because you don't understand the machinery underneath. All you're doing is matching shapes on the screen. But if you do understand it, you can look at the level you've never seen before and reason your way to whether it matters. That's the difference between memorizing and actually understanding. So here's the machinery. Supply and demand is what actually moves the price. It's the oldest method in trading, and underneath the fancy names, it's just basic economics. Now think about how the big money actually operates. Say a fund wants to buy $2 billion of something. They cannot just click buy. If they dump a $2 billion market order all at once, they would move the price against themselves so hard they get a terrible average fill. So what do they do instead? They leave resting limit orders sitting at a specific price levels. So here's the part that explains everything. Price drops down to that level, part of their order gets filled. And that buying pressure pushes price back up. Price comes down again, more of the orders fills, price bounces again. That is why levels get multiple touches. It's not a magic, and it's not the pattern. It's a large order being filled in pieces. And it also tells you exactly why levels eventually break. Once that order is completely filled, there's nothing left down, there's defending the price. So the next time price arrives, it just goes straight through. The level didn't stop working. The order ran out. So practically what you're doing, what you're marking, is where big money already showed its hand. A demand zone is where buyers overwhelmed sellers so hard that the price rocketed away. So when price returns, buyers are likely still there. A supply zone is the opposite. Sellers overwhelmed buyers, price dropped hard. And when price comes back up, sellers reload. You're not predicting anything. You're reading a footprint. One more reason levels form, and it's simpler. Psychological levels. Big round numbers, 1.1, 7,000 on indexes. Humans place orders at round numbers, and it's just how our brain works. So those levels attract real volume for no technical reason at all. So now you know why they work. The question is, which ones to actually trade? And here's where almost everyone gets scammed. This is the biggest lie you've ever been taught in trading, and it's quietly costing you money on every single trade. You've been told that higher time frame levels are stronger than the lower time frame ones. So what do? You mark up the daily chart, then drop down to the 5-minute time frame and try to trade those levels. And it creates chaos. Your levels are enormous, your entries are terrible, your stop loss has to be huge to accommodate a daily zone, and your risk to reward is destroyed before you even click a buy. So here's what actually true, and I say this having tested over 10,000 supply and demand levels. All time frames are equal, but not all levels are. There can be a strong level sitting on the 5-minute chart that eventually turns the trend on the daily time frame. The time frame a level lives on is not what makes it strong. That's a scam. So stop marking up higher time frame levels to trade on the lower ones. Instead, you pick one time frame based on the type of trader you are, and you find all of your levels there. Scalper, 3-minute time frame, day trader, 15-minute time frame, swing trader, 4-hourly time frame. Investors are gonna look at the daily time frame. And if you've got a job at a 15 to 30 minutes a day, you're a day trader. Your entire world is the 15-minute chart. Every level you mark, every entry you take is on the 15-minute time frame. No jumping. No, let me just check the daily real quick. One chart, one time frame, permanently. But you've still got a 20 levels on that chart. So which ones are actually matter? This is probably the single biggest lesson you will ever learn about supply and demand. If you take nothing else from this video, take this one. Here's the mistake. You think older levels are stronger, that a zone that is 3 weeks old carries more weight because it's been respected longer. It's the opposite. Past a certain point, a level is simply invalid. Price doesn't relate to it anymore. The market has moved on. Marking a 2-week-old level as a day trader is exactly why your chart looks like a spider web, and why you keep taking trades of those nobody defining them anymore. So the only thing that actually matters is how fresh your level is. And there's a rule for it. I call it a zone of relevance. It's a window you're allowed to look inside for your levels based on the type of trader you are. Scalper is going to look at the previous session. The day trader is going to look at the previous day candle. The swing trader is the previous week's candle. Anything older than that is just a noise. Genuinely, delete it. So now put the two rules together, and this is a whole system for finding levels. I'm a day trader, so I will look at the key levels on the 15-minute chart and only inside previous day's candle. That's it. One time frame, one reference window, and watch what that does to your chart. You go from 30 random lines to maybe 2 or 4 levels. and every one of them is fresh, relevant, and on the time frame you're actually trade. Your chart gets quiet, and when your chart is quiet, the setups becomes obvious instead of hidden in the noise. Now, I know what you're thinking. Show me, and I will. By the end of this video, I'm going to pull up a real charts and walk you through exactly how I mark these levels up and how I trade them, start to finish, including live examples. So stick around for that. But first, there's the catch. Because finding a level, the right level, is only half of the coin. And this next part is what separates people who know supply and demand from people who actually profit from it. And quickly, if you want me to look at your actual charts and help you mark these levels properly with a feedback on your real trades, that's exactly what we do inside the mentorship. Honestly, having someone review my levels with me was the single thing that changed my trading. The link in the description below. Now, the catch. Here's what nobody tells you right after they finish teaching you levels. And it's why people with beautiful loans still lose money. Because knowing where price will react tells you absolutely nothing about which direction to trade. You can mark a perfect demand zone, price taps it exactly like you called, and then it slices straight through and takes your stop loss. You were right about the level and still lost. That's the most frustrating loss in trading. And it happens because you only had half of the equation. To be profitable, you need two things: direction, where the price is going, and entry, where you get in. Your levels are the entry half. They tell you where, but they never tell you whether. And without a context, the market context, a level is just a place on a chart where something might happen. So here's how they combine. A demand zone inside an uptrend is a high quality long. You've got a direction and entry agreeing with each other. That same demand zone inside a hard downtrend, that's a knife and you're catching it. Same level, same drawing, completely different trade. The only thing that changed is the context around it. So your levels gives you the where. Your read on direction gives you the whether. You need both agreeing before you click. And to make all of this repeatable, especially on a small account, whether you can't afford emotional trades, it has to be 100% mechanical. Here's one thing that turns everything that I've just told you from a nice concept into a system that you can actually run on a 15-minute time frame, spending 15 minutes a day. Because right now, everything I've shown you is still a little bit subjective. Because if I put you and another trader in front of the same chart, you'd both mark slightly different zones. And that small gap is exactly where emotions, fatigue, and second guessing get in, which is fatal on a $100 account because you cannot afford to donate money to your own bad mood. None of these methods will work for you until you make them 100% mechanical. So rule-based that even your grandma could follow them and get the same results. No interpretation, no, it depends. And the way you make anything mechanical is beautiful in how simple it is. You introduce the time element. Think about it. Everything else on the chart is up for the debate, but time is not. The previous day's candle is the same for you, for me, and for anyone else. 9:30 is 9:30 everywhere on the earth. So the moment when you anchor your levels to your trading window to specific time, all the subjectivity disappears. You and I would mark the same zones because we're both looking inside the same time window, not our opinion of where a zone is. That's the whole reason my rules are built on the previous day's candle and on specific sessions open. Time is the anchor that makes it objective. Alright, now let me actually show you all of that on the real charts. Okay folks, not to waste your time, I have prepared 10 examples of how to trade supply and demand levels intraday on the 15-minute time frame. By the way guys, this is called the OP method number 2. We do have 3 more OP investing methods. I just want to mention that before we start. And some days it is good to trade the supply and demand levels. Some days it's good to trade manipulation, and other days it's better to trade the breakout and retest model. But in this case, we will be breaking down the OP method number 2, how to trade the supply and demand levels. By the way, guys, this is a chart on the 15-minute time frame. Do you see these vertical lines they break down these are the daily session breaks. So basically everything inside of these lines between the two lines is 1 day. So as you can see over here, we are marking up over here the previous day high. And according to OP investing methods, one of the strongest supply and demand levels are the previous day high and previous day low. But for that, you have to know some little conditions, how to trade them, when to choose the previous day high and previous day low. So one of these confluences are that previous day candle should be overextended. As you can see over here, it's a huge candle, and then we did have some pullback to the downside, and the price is going into the previous day high, retesting it and reversing to the downside. So here's the next one. Again, I'm saying that to trade the supply and demand levels, we are looking at the previous day candle. We are marking up the previous day low, the wick of the candle that created the previous day low. And one of the most important things over here is that we have to pay attention to the context. Just take a pen and paper, just save this video, come back to it and write down everything I'm going to tell you, I'm going to talk about right now, because it is going to give you a lot of hints. Guys, if you look at the previous day candle, it's a V-shaped formation. So it's basically the reversal candle. And as you can see over here, the next day, we're coming back to retest that week of the previous day candle and reversing to the upside. This trade is giving us over 10, guys, this is insane. This is how we trade the supply and demand levels. Again, the next case, the previous day candle, again, it looks like the V-shaped formation. The price is coming back to retest the candle that created the previous day low. This is the strongest demand level to reverse the price. Again, this is giving us over 10-hour trade. All of this is happening on the 15-minute time frame. All of the levels that we're trading are inside of the previous day candle. And even if you look at the next candle, it is just going to the upside and reversing from the levels during this day. So basically, to trade the supply and demand as a day trader, all you need is the previous day candle on the 15-minute time frame, and all of the levels inside of the previous day candle are going to be the key levels for you. Let's break down this example. As you can see over here, guys, over here we are having the OP method number 1, the breakout and retest model, because in the next day, as you can see over here, the price is going to the downside and retesting this swing low, which worked out as a perfect demand level for us. And then the price reversed to the upside and we're getting over a 10-hour trade. This is crazy. Guys, by the way, this strategy, OP method number 2, has a win rate over 50%, with on average you will be winning like 5 hours per trade. And again, folks, you have to understand that this is not a holy grail. It will fail sometimes. For example, the previous day candle, I don't know, it looks like a V shape to the upside or to the downside. But then anyway, like we have marked up the previous day low and the price smashed through it. Like sometimes it is not going to work 100% of the time. There is no holy grail in trading. And if you're looking for a 100% win rate, you're gonna lose. You will not become a profitable trader. Over here, we do have this case. The price went, retested. Over here, this is a previous day candle. This is on the 15-minute. We're marking up the candle that created the previous day high. The price is going up, retesting 50% and giving over 5 hours. I'm not sure like how many are over here. Probably more than 5 hours, definitely. The price is giving us more than 5 hours, but then it is just continuing to the upside. In any way, this is how it is working. And again, over here, as you can see how the price is reacting to this level over here. This is beautiful, guys. This is beautiful. Over here, the previous day candle is the V shape again. The price is falling back to the downside, retesting the previous day low. The candle that created the previous day low, we are having a reversal to the upside and 5-hour trade. This is beautiful, guys. This is beautiful. And again, another failing trade As you can see over here, the previous day candle is trendy. It is going to the downside. We were expecting for the price to reverse from the previous day high, but it failed. Again, there is no 100% win rate. Over here, you can see a couple of trade examples. Over here, we do have the OP must number 1 to the upside. This is a breakout and retest trade. And by the way, guys, I will give you a hint at the end of this video how you can learn how to trade all of the 4 OP investing methods, combine them, and have the best win rate, best risk to reward ratio. And anyway, like breaking down this supply and demand trade, as you can see over here, the price is going to the upside, retesting the previous day high, the candle that created the previous day high, which is the perfect supply level, and then the price is reversing to the downside, giving us over 5-hour trade. This is another example, guys. This is a previous day candle. As you can see over here, it dropped, made a retracement, dropped down to the downside, and then this is today's candle, kind of like, and then the price is going to the upside, retesting this swing high, which has an imbalance above it, which made a huge drop to the downside. Again, everything that I have mentioned in this video. So this is a perfect swing high. This is a perfect level to trade the OP must number 2. And guys, this is beautiful. Trading the OP must number 2, trading the supply and demand levels, having a reference point. Like, you will not be wondering where the hell is your supply and demand levels. You have a specific time zone, specific reference point, specific time frame you trade on. Everything is super duper mechanical. Like, inside of the previous day candle, you only have one previous day low and one previous day high. Inside of the previous day candle, you will have a couple of swing highs and swing lows that you can use as a potential level to trade the supply and demand. So basically, this is going to be the same for you, for me, and for anyone else. And this is going to work for any type of traders. Whether you're a swing trader, you're trading on the 4-hourly time frame and marking up your key levels during a previous day candle, or you're a scalper, you're trading on the 3-minute, 5-minute time frames, you're marking up your key levels inside of the previous session. So basically, guys, this is beautiful. And again, if you need our help to implement all of this into your daily life, where you can spend less than 15 minutes a day to trade and win 1 to 2 high quality trades, find 1 to 2 high quality trades every single morning, set and forget your trades, no need to live execution, just send me a direct message with a word ready on Instagram or Telegram. I will leave the links below in the video. So let's bring it home. You don't have a $100 problem. You have a chart problem. And now you know how to fix it. You understand why levels exist, big orders filling up the price. The multi-timeframe thing was a scam, so you pick one time frame and stay there. Fresh beats old, so you only look inside your zone of relevance. The previous day's candle if you're a day trader. So, a level is only half of the coin. So you check direction before you click. And the whole thing only becomes repeatable when you anchor it to the time. Do that every single morning. Take your 1 to 2 clean trades, risk a fixed 1% and close the charts. That's the routine. Now, if you want the complete rule-based system I run on top of these levels, the exact entries, the exact times, all of it broken down step by step, I put together a free training that covers the whole thing. It's the first link in the description below, and it's the next thing that you should watch. I'll see you inside.